Hello, CA Foundation champs. Hope you all are doing amazing. I also hope that your preparation are going at a wonderful pace. Now, in this video, let's revise the chapter number 7, that is preparation of final accounts of sole proprietor. This particular chapter has two units, guys. First unit covers final accounts of non-manufacturing entities, and the second unit will have final accounts of manufacturing entities. From the exam point of view, this becomes a very important chapter because you can expect at least 10 to 15 marker question directly coming from this particular chapter. This particular chapter is also very interesting to solve if you have that strong conceptual clarity, guys. The objective of this video is 100% obtaining that conceptual clarity and also look at the most important questions. As I mentioned, it becomes very important to look and practice before you approach your exams. So with the same spirit, let's begin the session, guys. So unit number 1, as I mentioned, final accounts of non-manufacturing entities. First of all, what is this non-manufacturing entities? These are those entities which are engaged in the activities of pure trading. So what does trading include? Buying and selling of goods. So this does not include any particular alteration to products or goods which they buy, because this is non-manufacturing entities. So that is what is mentioned here. At the end of the accounting year, the entity must be interested for what? In knowing the results of the business. What are the results of the business? They have to check whether they are operating towards profit or loss. In this case, what does it say? To ascertain the final outcome of the business, that is income and financial position, they prepare what? Financial statements at the end of the year, which we are going to learn in this particular chapter. So financial statements, we can analyze this in two statements. One is income statement, another one is position statement. Income statement is further classified into two sets, that is one trading account, another one being profit and loss account. What is the resulting figure in trading account? We comply this with gross profit or gross loss. What is the resulting figure in profit and loss? We arrive at net profit or net loss. And then in the position statement, we have balance sheet, which just presents your assets and liabilities. This reflects position of assets and liabilities. This is just an overview of what financial statements includes. The profit of the enterprise is obtained through preparation of income statement. Income statement includes trading and profit and loss account. So profit or loss. See, wherever we find out profit, loss is read as it is. So either profit or loss can be obtained in income statement. Income statement includes trading account and profit and loss account. The financial position of the business enterprise is judged by measuring the assets, liabilities and capital, and the same is communicated to whom? Ultimately, whatever we present is important because it needs to be communicated to the users of financial statements. If you have read initial theory chapter, this is what the ultimate objective of the entire accounting process is, that is to communicate to the users of financial statements. Now this is just what we understood as an overview. Now here, what have I presented is, you can just get that idea of where the placements of items, that is with respect to capital and revenue, and then the classification like income, expense, asset, liability and capital will be presented. So as we are all aware, in balance sheet, we can only observe all capital transactions. So in balance sheet, we can find out three things coming. One is your capital, liabilities and assets. So if you observe, the same things are mentioned here: liabilities, assets, and there will also be capital coming here under your liabilities side. Do not focus on whatever other things are mentioned. First, just observe what is present here. And in profit and loss account, or your trading for that matter as well, it includes what? All revenue transactions. This includes particularly all nominal accounts. What does nominal account include? Your items of income or expense, loss or gains. So that appears in your profit and loss account. Whereas if you observe under the liability side, it includes only those accounts which are in the nature of personal accounts. Example, if I have any bank loan, if there is any creditors in my business, any long term borrowing, those represents personal accounts. So that will be reflected here under the liability side. Look on to the asset side. It reflects all real accounts because the real accounts itself consists of the asset category precisely. And along with that, there could also be some personal accounts. Some personal accounts, as in, you can see, take the very common example of debtors. Under personal, there is also a category called representative personal, wherein we have all items representing as prepaid outstanding. That can also be observed where it takes a place in the balance sheet. Coming to profit and loss account, it includes all nominal accounts. On the debit side, you record all those items which are in the nature of expense or loss, because the nominal account rule also says debit all expenses or losses. Likewise, on the credit side, we record all income because credit all income or gains. Now here, if you observe, depending upon the accrual concept precise that we will have to record the transactions or events based on its occurrence, that is in the current year. So on this consequence, what happens here is there could be items of expenditure or income which is pertaining to current year. Based on accrual concept, we will have to record it on the occurrence basis. The second question comes whether the amount of expenditure is actually paid or if the amount of income is actually received. So this is where we understand the concepts of outstanding or accrual, that is outstanding income or accrued income. So in this case, what will be the classification if, for example, any particular expenditure is being recorded? Make sure first whether it is recorded for the current period, that is how much ever the benefit is being consumed. On top of it, we will have to look at the expenditure, whether any particular amount in the expenditure is outstanding. If it is outstanding, there will be two treatments. First, you will reflect it in your profit and loss account for the simple reason because it belongs to the current year based on the accrual concept. Second, since this is outstanding, this need to be also reflected as your liability because it is still not being paid. It is your obligation which was not complied in the current year but should be complied in the upcoming years. Therefore, as on today, it will be outstanding. So here, if you observe, the expense will be recorded in the profit and loss account since it has outstanding balance. This outstanding will also find its place in the balance sheet under liabilities side. I hope you understood this connection. Similarly, on the asset side, if there is an income which belongs to the current year, so first point is it needs to be recorded in the P&L because the income belongs to current year. Second question, has the income completely received or is there any particular part being accrued? So now the consideration here is income belong to the current year, but there is some proportion which is accrued. That is, it is receivable in nature. It is still not received in the current year. So in this particular case, you will first record it for the purpose because it belongs to the current year. Since it is outstanding, that is accrued, it is receivable in nature. It also finds its place where in the asset side in the balance sheet because it is receivable in nature. I hope you just understood this entire structure, how the placements will happen. Yes. Moving on to preparation of final accounts. What is the basic steps we need to comply in order to prepare and present final accounts? See, the principal function, that is the objective here, is to exhibit what? True and fair presentation of what? The profitability and the financial position of the business. Whenever we look at financial position, it is nothing but indicating our balance sheet which presents our assets and liabilities. The basic principles in regard to accumulation of accounting period data, because data accumulation becomes very important. So first of all, it has to be distinguished between personal and business income and expense, and then there should be a clear distinction between capital and revenue items. All material information to be disclosed. See, these all becomes purely accounting judgments. What is material and what not. And then record only current period transactions, because we are only focused on current year results. Only transactions completed before close of accounts should be given effect, because ultimately this is the last step after we start from analyzing the data, that is identifying it, then record it in the primary books of accounts, that is journal, from journal to ledger, then from ledger to trial balance, and ultimately this will be reflected in your final account. So therefore this reflects only those transactions which impacts your close of accounts. Matching principle. This principle demands that expenses incurred to earn the revenue should be properly matched. So what does matching principle proposes is, whatever expenses you record is nothing but should be matched with whatever revenue earned in the particular period. Yes. So first, trading account. This trading account takes lot of knowledge from our chapter number 4, inventory, because it gives the same connection of items whatever we discussed there also. See, gross profit is the nothing but the resulting figure from our trading account. That we just saw it in the overview. Gross profit or gross loss. So gross profit is arrived as difference between selling price and cost of goods sold. If you also remember, the same gross profit was also learned as gross margin in the inventory chapter. Now, how to calculate this? Opening stock plus purchases. Purchases we take net. That means if there are any returns, we will not reflect it here. Add direct expenses. We will take net of purchases. That's what I mean. And then add direct expenses to the resulting figure. We will subtract cost of goods sold. So ultimately what we get is nothing but closing stock. See, in this formula, we can rearrange any particular item in order to find the other one. Gross profit is usually ascertained by preparing a trading account. In final accounts, we generally arrive at gross profit by presenting all the relevant information in trading account. This is the format of trading account. How to start? Trading account of the respective sole proprietor's name need to be mentioned for the year ended. Generally, it will be for 31st March, but it also becomes important to look at the question and then mention the year ending date here. Yes, here is the format of trading account. Trading account of, you'll write the name of the sole proprietor here for the year ended 31st of March. Generally, it will be 31st of March, but it is always better to look at the question when is the year ending and then write the date here. So, trading account is a simple ledger where we present it, or it takes the nature of a nominal account. On the debit side and credit side, what all items need to be presented? Let's observe. So trading account begins with opening stock, because as trading means buying and selling of goods, if we want to continue the business, we require goods. So it begins with opening stock, and then any purchases made during the year. With purchases, if there are any purchase returns, purchase returns can also be called as written outwards. We will subtract this and show the net amount in the outer column, and then we record all those expenses which are direct in nature. So in this particular situation, please understand clearly what are direct expenses. Direct expenses are those expenses which are incurred by the business in order to make the product ready to sell in the market. All those expenses incurred in this particular course will be called as direct expenses. It becomes very important for you to follow this particular format, because trading account will have to reflect all those expenses which are direct in nature, whereas your profit and loss account will record all those expenses which are indirect in nature. Similar to income, trading account will record all direct incomes. Profit and loss account will record all indirect incomes. All right. So, few examples for direct expenses: freight and carriage, Customs and insurance, freight and carriage are nothing but transportation costs. Customs and insurance, customs becomes your tax related expense, which becomes important if there are any import export activities involved, and any insurance taken on the safety of goods, any wages paid to laborers, then gas, water and fuel in order to run the factory, other factory expenses, and then any royalty on production. This royalty on production is connected to a manufacturing account, manufacturing activity. We will understand more while we discuss manufacturing account there. And then on the credit side, buy sales, similar to purchases, if there are any returns, we will subtract this return inwards. Then buy closing stock. If there is gross profit, because gross profit is nothing but excess of income over expense. So if we have to balance the ledger, the balancing figure appears on the debit side. So to gross profit carried down. So then if there is gross loss, that is if your expenses is excess than income, so there will be gross loss. So gross loss appears on the credit side. This was a format of trading account. Either gross profit or gross loss, any one will appear in each case. The rule is that this account will be debited with all expenses incurred in bringing the goods to their present location and condition. That is nothing but this is talking about direct expenses. That is debited with all expenses is nothing but direct expenses. Yes. Now we will understand respective items, whatever we saw in trading account, their respective treatment one by one. Closing inventory and its valuation. So with respect to inventory and its valuation, we have some idea from chapter number 4. So let's also keep that as a base and understand this further. Usually there is no account to show the value of the goods lying in the go down at the end of the year. Think logically, guys. Do we actually maintain a separate account to just show how much is left out at the end of the year? We incidentally call it as a closing stock, but we do not maintain a separate account like we do it for purchases, like we do it for sales. Now here observe, the entry will for this will be closing inventory account debit to trading. That is what you reflect here. See, this is a trading account, and on the credit side when I write closing stock, by closing stock is what I reflect. So journal entry will be closing stock account debit to trading account. Alternatively, closing stock can also be adjusted with purchases. Understand this. Why is it linked to purchases? See, first of all, any businesses start with opening stock, and then there will be additional purchases during the current year. Using these two balances, they make sales. Yes or no? Opening stock plus purchases, they have the enough quantity to make sales. Whatever is left out is nothing but by closing stock. Now in this case, if there are any units left out from the purchases, closing stock can also be routed, that is adjusted with purchases. So on that particular time, the entry will be closing inventory account debit to purchases account. Remember, while I incurred purchases, I would have debited because it is an expense, purchase account debit. Now, out of the total purchase, I am not at all consuming the entire thing for the current year. So, purchase was an expense. Remember guys, I will record the expense depending whether it is revenue or capital based on the benefit derived or benefit consumed. Purchases, I would have treated it as revenue expense, expecting I will consume the entire purchases made in the current year itself. Now, since entire consumption was not possible in the current year, some part is left, which I call it as closing stock. Now, the question comes here is, part of expense which was supposed to be consumed in the current year is not consumed. So that means it will be carried forward to the next year. Benefit will be consumed in the next year. Remember, this is where the classification will be identified. If the expenses are consumed in the current year, this amount spent was revenue in nature. Now, since the benefit will be postponed for consumption in the next year, expense will be converted as asset. So, this is where closing inventory or closing stock gets created. So then if the asset is created, therefore asset will always by default have a debit balance. So closing inventory account debit to purchases account. So I am rerouting the expenses from purchases to an asset. So therefore, closing stock will be debited and purchases will be credited. The effect of this entry is to reduce the debit in the purchases. That is what I explained. The closing inventory is also shown. Where is it shown? One effect will be in your trading account. One more, it will be reflected in the assets, that is in the balance sheet asset side. The valuation principle will be same what we understood in inventory, that is cost or net realizable value, whichever is lower. Closing inventory valuation, this principle is a must to follow. If the question gives you two values, that is cost or net realizable value, you have to apply this principle. You will take whichever is lower. Yes. If closing stock appears in the trial balance, see this could be a possibility wherein you will have to first observe all these things in the question. Where is closing stock actually coming? So if you are actually revised the topic before, you will be able to connect better. See, if you observe a final accounts question, closing stock majority times will be given in our additional information or adjustments. So without any second thought, we will directly record it two places. One is in trading account, one more in the balance sheet asset side. But sometimes closing stock can also be given inside the trial balance. What does this concept explain us about? See, if the closing stock is appearing in trial balance, don't you think, while we discussed rectification of errors, if you remember, those items which appears in trial balance in simple words means journal, ledger, and then it has been reflected in trial balance. That means entries are everywhere addressed. So that is when it finds its place in trial balance. If it is coming in adjustments, the entry is not at all reflected because closing stock is an event, guys. It is not a transaction to record and then classify it further. So there is a possibility that closing stock might need not be separately valued. Therefore, you find that in additional information. What if the closing stock is appearing in trial balance? Then what is the treatment? See, the closing inventories is then not entered in the trading account. This is very important for you to consider. Till now, what did we understand? Closing stock appears in two places. One in my trading account, one more in the balance sheet asset side. If the closing stock appears in trial balance, it will not come under trading account. What is the reason? See, first of all, let's understand this treatment. It is shown only in the balance sheet. So what is the summary here? If the closing stock is appearing in trial balance, it will only be shown in the balance sheet asset side. It will not come in trading account. What is the reason? This is because it has already been adjusted to arrive at cost of goods sold. Don't you think here, whatever we understood in this particular format, cost of goods sold is arrived at by taking opening stock plus purchases plus direct expenses minus closing stock. So this is when we get cost of goods sold. So in this particular case, closing stock is already considered in that structure in order to find out cost of goods sold. Again, if you separately record in trading account, what does it symbolize? You are just making a double entry which becomes completely wrong. See guys, in trading account, ultimately what is reflected? Your opening stock, purchases and direct expenses, right? Opening stock plus purchases plus direct expenses minus closing stock is nothing but cost of goods sold. So this is indirectly already been reflected. So again, you will not separately show closing stock in a trading account because this treatment is already taken care. So that is why if closing stock is appearing in trial balance, then it will not come in trading account. It will only come in the balance sheet asset side. I hope this point is clear to each one of you. In case closing stock is not mentioned in trial balance, then it means opening stock and purchases appearing in trial balance include the value of unsold stock. That is, whatever is reflected as opening stock and purchases in trial balance has closing stock proportion, which is not at all separately identified yet. Since we prepare our financial statements using matching concept, such unsold stock should not form part of cost and therefore is deducted. Matching concept reflects what? On top we just observed, you will have to match current year income with the current year expenses. Now closing stock is something which is not at all consumed this year. That is, you are not at all making any revenue by using that for sales, correct? So therefore, based on this concept, this unsold stock should not form part of cost. So therefore, what do? We take it out as an expense and then classify it as an asset. That is what we understood in the journal entry. Therefore, in this case, to compute cost of goods sold, we will have to use COGS, that is cost of goods sold, is nothing but opening stock plus purchases minus closing stock minus if there is any purchase returns. Ultimately, I hope this discussion of closing stock, which is important, understood carefully. So, just to summarize, if closing stock is appearing in trial balance, then it will not be appeared in trading account. You will only reflect it in the balance sheet asset side. Second case, if closing stock is not appearing in trial balance, that means where it will come in the additional information. Then what all items coming in additional information, also called as adjustments, will have two appearances. One, it will come on the credit side, trading account. One more, it will be reflected in the balance sheet on asset side. Clear? Yes. Last, after we record all of these items, the gross profit or gross loss is the ultimate resultant in the trading account. The gross profit which we have recorded will be transferred to which account further? Profit and loss account. So the entry for this will be trading account debit to profit and loss account. The entry for gross loss, if there is any loss, P&L account debit to trading account. I hope all of you understood the detailed discussion with respect to trading account. Moving to next one, profit and loss account. As we just saw, trading account will transfer gross profit or gross loss. So profit and loss account should start with what? Gross profit on the credit side. If there is gross loss, it will be written on the debit side. After we open by bringing forward the gross profit or gross loss, we will start recording all those expenses or losses which have not been entered in the trading account. Incidentally, it means all those expenses or losses or incomes or gain which is indirect in nature. So this will be written on the debit side of P&L, income and gains other than sales, because sales will be shown in the trading account, will be written on the credit side. Further, it may be noted that the expenses which are personal in nature will not be charged to profit and loss account, because this is purely business books. So we will not mix up personal and business. So you will record all those items which are related to business alone. Only those revenue expenses and losses which are related to the current year are debited to profit and loss account. Which are related to current year is very important, because based on this the treatment will accordingly come. So the profit and loss account format is given to you. Profit and loss account, if only separately asked, you will just start telling profit and loss account for the year ended. If not, if the complete question is asked, that is to prepare trading, profit and loss account and balance sheet, we can just prepare one particular format. Upper part will be trading and the continuation will be your profit and loss account. So for both, we will just put one heading, trading and profit and loss account for the year ended. What am I telling? You will understand while we solve the question. So this is just the format of P&L account. So either we start with gross loss or gross profit. We will record all those incomes which is indirect in nature. Examples could be discount received. These are all your gains. Commission received. Bank interest. Rent of property let out. This is purely business rent. And if there is any dividend for investment made in shares, that will be also recorded. Abnormal gains, profit on sale of machinery, profit on sale of investment. See, these headings are not important for you to separately mention in the format. This is just given for your understanding here. Yes. Next, on the debit side, to salaries, that is administrative in nature, office rent, rates and taxes. Understand one thing clearly here, guys. If there is a factory rent, we will consider it as a direct expense. So that will be taken to trading account. If it is an office expense, we will consider it as an indirect expense and it will be shown in profit and loss account. To printing and stationery, telephone charges, postage and telegram, insurance, audit fees, legal charges, electricity charges, and then if there is any repair expenses, another important item is depreciation on your fixed, tangible as well as intangible assets. If it is on intangible, we consider it as amortization. And then any selling and distribution expense, salaries, advertisement, go down rent, carriage outward, carriage inward. If you remember, we have taken it to trading account. Carriage outward is again a transportation expense. Carriage inward was also a transportation expense. Ma'am, what is the difference? Carriage inward is an expense which you incur to get the goods or product to your business premises. Whereas carriage outward is you incur the transportation expense to send the goods to the customer's premises. Yes. Then to bad debts, to provision for bad debts, and then selling commission, bank charges, interest on loan, discount allowed to customers. And if you observe here, if there was any profit on sale of assets, we recorded it on credit side. If there is any loss on the debit side, after considering all of these items, the resultant figure in P&L account will be either net profit or net loss. Now, this net profit or net loss is transferred where? To capital account. Now, whatever we saw as per the format is just to give you an overview. Now, we will understand the treatment of each items individually. Either net profit or net loss, any one will appear in each case. Yes, first item, drawings. Now, drawings is nothing but nature of expense, if you think from business point of view, which is personal in nature. Now, this is an expense related to the owner of the business. So, what is representing with respect to owner in the business? Capital. So, what does the business treat as? If there is any drawings, we will consider this as if the owner is drawing from his own balance. His own balance is reflecting in the form of capital account. So, capital account by default will have a credit balance. If there are drawings, the balance is dropping down. So, what should we do? We will debit. Capital account will be debited to to drawings account. Next point, income tax. Understand this carefully here. In case of companies, the income tax payable is treated like other expenses. So if it is other expenses, we will have to record it in profit and loss. This is for whom? If it is a company. But in case of sole proprietorship, income tax is treated as personal expense. What is the chapter name? Final accounts of a sole proprietor. So, in this particular chapter, if you observe income tax, by default, we will consider it to be of sole proprietor, which is personal expense in nature. So, this is treated as personal expense. So, if it is a personal expense, same treatment like we did it for drawings. It is debited to capital account and not to the profit and loss. So, what will be the entry? Capital account debit to income tax account. As well, in case of partnership business, we understood what is in case of company. Firm's tax liability is to be debited to profit and loss account of the firm, but partner's tax liability are not to be borne by the firm. See, partner accounts are different. Firms, partnership firms account is different. So here what they are talking about is if there is income tax of a partnership firm, that will be debited to P&L. If it is income tax of respective partners, that will not be treated as a business expense. Therefore, if the firm pays income tax on behalf of partners, such payment of personal tax should be treated as drawings. So they have given completely from the point of view of company, from the point of view of sole proprietor, and from the point of view of partnership firm. I hope each cases have been properly understood. Next, discount received and allowed. Discount received is what for any business? Discount received is a gain. So where do we record all the gains? On the credit side of P&L. If I have to present this in the journal entry form, so discount received account debit to profit and loss account. If it is discount allowed, it is a loss. How do I reflect it in the profit and loss account? In profit and loss account on debit side. So P&L account debit to discount allowed account. So if you wonder why is the entries like this, see, nominal account rule is debit all expenses or losses, credit all incomes or gains. But here it is reflected on the opposite side. See, this is nothing but the transfer entry. Because this is a nominal account, you will not have balances to be carried forward further. So any balances we will have to transfer it to profit and loss account. So therefore you will observe the entries in this format. This is the closing entries. Next, rebate. Rebate in other words is nothing but in the nature of discount. So when rebate is given, this is given to customers generally. So the journal entry will be rebate account debit to customers account. In the year end, that is when you close, you have to transfer this. Again, rebate will be in the nature of a nominal account. It will be taken to profit and loss. Profit and loss account debit to rebate account. Next, bad debts. Now, what is bad debts? When any customer who was supposed to pay to the business has failed to pay, that due amount is nothing but my bad debts. See, when a customer does not pay the amount due from him and all hopes of recovering the amount are lost, it is said to be a bad debt. It is nothing but a loss to any business. Therefore, bad debts is debited, which is later written in the profit and loss account of the debit side. So first let's understand the structure. Why will there be a bad debt? First, there should be a credit sale transaction. When the credit sale happens, there will be debtors who will be made receivable for the goods you have sold. Now, out of the amount which is to be receivable, if proportion or part of it is unable to recover, so that is nothing but my bad debts. Now, this bad debts is emerging because the debtor is unable to pay the balance amount, or he's of some uncertain situation which is not sufficient balance enough to settle the due. So in this particular case, what will be the first entry when the bad debt happens? Bad debt is a result because there was debtor who was supposed to pay the money to the business. So the journal entry for this will be bad debts account debit to debtors or customer account. At the end, when the account should be closed, that is to be transferred, bad debt is the loss. So this will not have any balances carried down. So this will be routed with profit and loss account. So profit and loss account debit to bad debts account. Next, in case of provision for bad debt has already been prepared, then bad debt should be written off first from it. First, let's understand what is this provision, guys. Provision is nothing but we are expecting some uncertain situation. Instead of facing that situation when it actually occurs, we will be ready by ourselves to face that situation. So what every businesses does is they will just set aside a portion of profit if in case they face any such situation. This amount which was set aside can be utilized. So now this is a provision created with respect to bad debts. That is, you have that thought, you are expecting some of the debtors might turn out to be bad. So instead of facing the loss as and when they confirm that they are unable to pay, let me safeguard my situation today. So what every business does is if they have any excess profit, they will set aside a portion towards provision. So provision is nothing but you are expecting that there could be bad debts in future and creating a portion of profit with a balance. Clear? Now, what are they telling here is in case of provision has already been prepared, then bad debt should be written off first from it. So you had created a provision with an expectation that there could be some debtors who will turn out bad. Now, bad debts happen. You had already expected this before. Bad debts, when it happened, is nothing but a confirmation. So now, how will the treatment be shown? First of all, bad debts is a loss. This loss you had already expected. See, provision will be created on estimation basis. You don't know how much could be the loss. Now, with respect to the bad debts happened, the provision could be having extra balance or the balance could also be falling short. So in this case, first we will have to compare the amount, that is bad debts with provision. So if we compare the amount, if there is any balances available with respect to provision, first I will utilize that to set off the bad debts. When I make use of it, the entry for this will be provision for bad debts account debit to bad debts account. See, before this, while the provision would have been created, the entry would have been profit and loss account debit to provision for bad debts. You will understand this in a further journal entry. So this reflects that you are setting aside a portion of profit. Now, when you are utilizing this provision, so provision which will generally have a credit balance, since I'm utilizing it, so that will be debited to bad debts account. That is, remember, bad debts to profit and loss, what we were doing. So that will be reflected here. If later on the amount is recovered, it should be treated as a gain. That is, currently at some point of time there was bad debts. After some point of time, there is a recovery of such bad debts. Now, this bad debts recovered is nothing but your normal gain. So, how will we record this? Bad debts recovered account debit to profit and loss. That is, in profit and loss account, we will show this on the credit side. Clear? Yes. Next, moving on to adjustments. Yes. First point, expenses accrued and accruing. See, in this case, first we have to understand that what as the expenses we need to record. So, under matching principle, we understood that we will have to first match the current year revenue with the current year expenses. That also becomes our base. And then comes the accrual concept. The accrual concept proposes that you will record all those transactions which in the nature of expenses or income which have been occurred in the current year. So if you observe incidentally with respect to trading and profit and loss account, we will be recording only those expenses or income which belongs to the current year. So what is this expenses accrued and accruing? So, first of all, we have to look at that the expenses, what are the amount which is belonging to the current year. So, the next question comes, is the expenses with respect to current year has been completely paid? Now, if I'm addressing current year, it means for a period of 12 months. So, we have to check that whether the expenses have been paid for 12 months. So, if some expenses which were supposed to be paid for 12 months, some months are remaining unpaid. So that unpaid proportion will be considered as an outstanding expense. So expense is nothing but the benefit which you would have derived and it belongs to the current year. When you have already consumed it, it becomes your liability to first pay it. If it is not met in the current year, so it will be met in the next year. So for this particular year, I will have to record this as an outstanding expense. So this outstanding will be classified as a liability. So the entry for this will be respective expense account, be it salary, rent, wages, or any particular expenses account debit to outstanding expenses. That is, first you will debit the expenses and then classify it as a liability. Liability will have a credit balance. So to outstanding expenses. Same logic what we understood for closing stock, guys. Yes. Next, on the same note, if there is any income which belongs to the current year should have to be recorded in my profit and loss account. So if there is any income accrued or accruing, and if the income is completely not received in the current year, then you will first record it as the current year income. Then those which is still not received will be classified as an accrued income. That becomes your receivable. If it is a receivable, that means your asset. So in that case, what will be the journal entry? Income accruing account debit to appropriate income account. That is, income will have to be credited. So that will be credited. Since the income is yet to be received, it becomes receivable in nature. So receivable means asset. So therefore we debit. So those income which will be accruing. So the term accrued here signifies that the amount has been incurred as expense or earned as income, the due date of payment which falls in the next financial period, not related to current year. If the due date of payment occurs in the current accounting period, the term used should be outstanding or accrued and due. So if it is related to expense, we will generally use outstanding. If it is connected with income, we will use accrued and due. Clear? Yes. Next, income received in advance. Again, same thing. You will have to record the current year income alone. But incidentally, assume you are receiving extra income. Assume you have to show 12 months income, but you have already received income for 13 months. So 1 month income is not belonging to current year, but you have already received, for which you will have to provide something from your end, be it with respect to sale of goods or any particular service. You are yet to deliver your obligation, but the income is already received. So this particular income, which is received well in advance for that particular extra 1 month, will be in the nature of a liability because you are yet to satisfy the obligation. So therefore, it becomes in the nature of liability. What will be the journal entry for this? Appropriate income account debit to income received in advance. Why? Because I will have to record only 12 months income. If I have to show that 13 months income, 1 month income will be debited. Two, since it will be a liability, credit, it should be a credit balance. So to income received in advance account. Clear? Next, payments made in advance. So in the first case, we understood what if expense is outstanding. Now, what if the expense is paid in advance? So you will have to record those expenses only belonging for 12 months. In this particular case, if you have anything extra, which is paid for the next year in advance, how will you show this? Prepaid expenses account debit. Why you are debiting? Because this becomes in the nature of asset. You have complied your part of the obligation, but you are yet to consume the benefit. So when it is yet to be consumed, it is as good as nature of receivable yet. So we will debit it, showing it as an asset, and to credit appropriate expenses account. Next point is adjustment of inventory of materials in hand. If there are any stock of materials in the nature of your stationery, any advertisement material, manufacturing stores, these would have been normally recorded as an expenses incurred. But how should this get actually classified in the final accounts? Inventory of materials debit to appropriate expenses. For example, if I have any stationery bought, normally I would have booked it as a normal yearly expenditure. But in the stationery which was bought for the current year, I am left with some stock. So that becomes my inventory at the year end. So at that particular point of time, I will create this as an asset, same like closing stock, inventory of materials, debit to appropriate expense, because I would have debited it as normal expenses. Clear? Yes. Next year in the beginning, entries number 1 to 5 should be reversed. That is, if you are also presenting next year's financial statements, whatever we understood from point number 1 to 5 will be reversed, because we are just recording this, what could be its identification from the current year's point of view. Clear? Yes. Next. Most important point next is provision for bad and doubtful debts. We understood this with connection with bad debts, but here again same thing, whatever we discussed there will also be relooked. When it is feared that some of the amount due from customers will not be collected, it is prudent that it is always better to predict what could happen, to recognize the expected loss by reducing the current year's profit. So when we do that, the entry what we observe is profit and loss account debit. Two, provision for whatever purpose you have created, be it for bad or doubtful debts. If you remember, under bad debts also, we understood this would be the entry. The accounts of the customers concerned are not affected until the amount is actually written off for which the entry is. That is, each individual customer's account will not be reflected or affected until and unless this entry is passed. That is, bad debts account debit to customer's account. With respect to this provision and bad debts, there could be different treatments where the question demands with respect to debtors calculation. So let me give you a few examples here. See, bad debts and provision. You have to first figure out whether it is appearing in the trial balance or in the adjustments. First, let's understand this one by one. If bad debts is appearing in the trial balance, understand one thing, that bad debts is already reflected in the books of accounts. In simple words, just fix on one point, that whatever is appearing in trial balance means the entry starting from journal ledger is already done. So bad debts if appearing in trial balance means it is already treated. Second point, if the bad debts is coming in adjustments or additional information, it is being informed to you that this particular bad debts is not addressed. That means in the trial balance, it is not impacted. You have to freshly give the treatment. So bad debts is happening because of some debtors who are not ready to pay, correct? So I will have some debtors balance. So what will be the treatment for bad debts appearing in adjustments? I will reduce it from my debtors. This is one treatment. Remember, I told you whatever items comes in adjustments will have two appearances. So one, I reduced it from the debtors. One more, because it is a loss, it will appear in your profit and loss account. This was a situation if the bad debts appear in additional information or adjustments. What is the treatment if bad debts comes in trial balance? You will just show it as a normal loss and record it in the profit and loss account. You will not reduce it from debtors. I hope this point is clear. Next, coming to provision. Provision for bad and doubtful debts. If it is coming in trial balance, what does it mean? The amount of provision is already created. You need not separately create if it is coming in trial balance. Second case, if it is given to you in the adjustments or additional information, the lines would be create a provision at 10% for doubtful debts or something like this. So if they give such information in the adjustments, what you should do is you have to freshly create the provision. So this provision, you are expecting that some of the debtors might turn back, right? So you will be given with the debtors balance, take that as a base and calculate the percentage given. Clear? So if you are creating from the treatment given in adjustments, it will have two appearances. First, you will set it aside from the profit. So one will be reflected on the debit side of profit and loss account. Second, this is the new provision which is created. So you will reduce it from debtors balance. Clear with this, guys? Yes. So this was the points to be considered with respect to bad debts and provision. One more situation. If both are given, bad debts as well as provision, keep the same points which I explained now as a base. If bad debts is given in the trial balance, additionally, bad debts is also given in adjustments. First, you have to conclude that whatever given in adjustments is a fresh bad debts. It was not known while it was prepared, while it was appearing in trial balance. That means the accountant was not aware of such bad debts. So, same like what we discussed for appearing in adjustments, you will reduce it from debtors, show on the debit side of P and L. Clear? Second, similar to provision, if provision is also given in trial balance and additionally they are asking you to create, first find out what is the expected provision as per the additional information. Compare this with the provision which is available in trial balance. For example, assume provision given in trial balance is 5,000. As per the adjustments, provision, if you apply the percentage, assume it is coming at 10,000. So 5,000 is short here. So what I will do, extra 5,000 provision will just be created because provision 5,000 will be taken as an opening balance and additionally 5,000. Clear? Yes. Another situation comes wherein you have bad debts as well as provision together. So this again you have to be careful where it is appearing, whether it is appearing in additional information or whether it is in trial balance. Now let's consider that bad debts is coming in additional information. Provision is already there in trial balance. Additionally, they're also asking us to create provision at 10% on debtors. So bad debts separately in adjustments and then provision separately in adjustments. Also, provision is there in trial balance. Now, you have to first bifurcate considering it as old provision and then new provision. What is old provision? Which is already there inside the trial balance. New provision is what you are yet to create, comparing with the balance of shortfall. Clear? Yes. So, if there is old provision, remember why you created the provision, because you were expecting there could be a bad debt. Now, from the additional information, bad debt happened. Whatever we expected happened. So first we will utilize that old provision to set off this bad debt. We understood the journal entry while we discussed bad debts. What do we pass for that set off? Clear? Then we will have to compare what is the additional provision percentage they are expecting. Understood? So whatever points I explained now can be presented in a simple structure in my profit and loss account. You will take bad debts. Now this bad debts will include both if it is appearing in trial balance plus what balances is given in the additional information. Clear? To this, I will add new provision, that is what is given in the adjustments. Then I will subtract old provision. This is not a formula you're supposed to by heart. Understand this logically. Old provision means it was already created in the trial balance. You created because you expected bad debts could happen. So that is why I am reducing it here. New provision, now they are asking us to create. So therefore I will add. Is this clear? So this calculation will appear in the amount column in my profit and loss account. In the balance sheet, what will be the impact? From my debtors, I will reduce any bad debts appearing in adjustments. Clear? Then, additional provisions, whatever they have asked to create, that is new provision, I will also have to calculate that and reduce it from my debtors. All those, whatever we discuss now, you can understand this with the treatments what we take up in questions. Clear? Yes. Next, provision for discount. Now, first, let's understand what is this provision for discount. This is not like my bad debts. There are few customers who you feel can pay you well before the due date. So, when the customers are taking that one step further, it also becomes a common healthy business practice that you should also give them some benefit because they are paying you well before the due date you had asked for. So, in this circumstance, what happens is if you are expecting that some customers would pay to me early than the time frame which I have fixed for, you should provide or grant some discount. So if you are aware that you might face that situation in the course of business cycle, you will also get ready for that situation by setting aside a profit and creating provision for discount on debtors. So in this particular case, if you are creating, the normal journal entry will be same, profit and loss account debit to provision for discount on debtors. While we provide this will have to be taken out from the debtors. But on what debtors balance? First priority to reduce from debtors will always be for bad debts and provision for bad and doubtful debts. After providing for this, if you are left with any balance, what does that represent? Good debtors. Good debtors means from whom I can expect money. So from whom I can expect money, some can pay me early, for whom I'm supposed to give discount. So on this particular debtors, I will charge this provision for discount on debtors. Yes. This provision is created in the same manner, but the amount is required to be calculated on what? After deducting the provision for bad debts from the total trade receivables. Total trade receivables means your debtors balance. This is because provision for discount is created only on for whom? This is only for good debtors. Good debtors means who have that prompt payment system. Yes. Next, provision for depreciation. When can provision be created? We have understood this in detail in the depreciation chapter. So if there is provision, profit and loss account debit to provision for depreciation. The amount of depreciation is deducted from the concerned asset and is then shown in the balance sheet. The amount is to be deducted from the asset and the ultimate balance is shown in the amount column. Next, another item, abnormal loss of inventory by accident of fire. There could be some uncertain situations like inventory is lost. The situation is due to accident or fire or earthquake, any natural uncertainties. At that point of time, how will we record this in the accounting books is accounting or trading account is to be credited. Why? See, first of all, this will be reflected through my purchases itself. Whatever goods lost will be treated as a normal loss. Goods will be reflected in your trading account. That's why you see opening stock, purchases, sales, and closing stock. So this loss entry will also be reflected in trading account. What is the first entry for that? Abnormal loss account debit. Why am I debiting? Because it is my loss. 2. From what stock the goods have been lost, it is represented in purchases. So to purchases account. Clear? Next, in that point of time, there could be an insurance transaction which is attached to such losses. If insurance claim is there, insurance company, that is claim account debit to abnormal loss. This is only when you have an insurance policy and it is in the nature of receivable. If it is in the nature of receivable, it takes the nature of an asset. So that is why I am debiting. Then abnormal loss, which was a loss through which I am able to claim insurance claim. So that's why it will be credited. So whatever is the loss, for example, assume the loss of goods is worth 1 lakh, but you are able to just get 80,000 from insurance money. So in that case, 20,000 is your loss that will be routed through profit and loss account. There are very rare situations that you expect more from the insurance policy. That's why we have this entry. Is this clear? Yes. Goods sent on approval basis. Goods sent on approval basis is not a concluded sale. It is just sent for a sample on a trial basis. If the customers feel, yes, the goods are comfortable for their consumption, or if they like the specifications, they can confirm the sale by sending the approval. So in this case, how will we record the transaction? The main role player here is whether you have the cost price or the selling price. See here, goods costing 10,000 sent to a customer on sale or return basis for 12,000. So what do we understand by this? This is my cost price and this is my selling price. At what price should we reflect in our books of accounts? The entry for this particular transaction would be sales account debit to debtors account. Why sales to debtors? Remember, while we do credit sale, the entry is debtors account debit to sales, right? Now, this is not a concluded sale. At the year end, when I'm checking the status, my goods are still not come back to me. The status is still not confirmed by the customer. At that point of time, sales account debit to trade receivables, that is sales account debit to debtors. At what price? At selling price, because it was debtors to sales normally. Now, when you take back those goods, it will get added to your stock of goods, right? So that will be reflected as stock on approval account debit because that was sent for approval to trading account. This is as good as closing stock. You are adding it to closing stock because for closing stock also, what is the entry we understand? Closing stock account debit to trading account, right? So similarly, this is shown. Remember, if you take back to your stock, you will not add it at profit element including. You will reflect it at only cost price. So that's why we are showing this at 10,000. I hope these points are clear to all of you. These goods should now be included in the amount of closing stock at their cost price. That's what I explained. Then, goods used other than for sales. There could be various situations where we are using goods for other purposes which is not sale. So first, when the goods are given away as donation, so you're just giving it as for a charity purpose, then the entry will be donation account debit to purchases because the quantity of goods comes down. When goods are used by the proprietor for his personal use, normal, very common journal entries we see, drawings account debit to purchases. When we are reflecting this entry, you should also be aware that what impacts it creates in final account. When it is drawings to purchases, your drawings balance will increase, purchase balance will come down. When goods are distributed as free samples or advertisement account debit to purchases account. When goods are used in the business for construction of building or the machinery, you will debit the respective asset account, building or machinery to purchases account. When goods are used for maintenance of business premises, again, you will credit purchases for whatever purpose you are doing, you will debit that. So repairs and maintenance account debit to purchases account. These are the transactions when goods are used for other than sale. Next, commission based on profit. So this is sometimes when managers are given the role on top of salary, they would also be paid commission for the work they provide because this is ultimately their driving force to generate more sales. How would you actually treat this in final accounts? First, you have to understand whether the commission is given on net profit before charging or it is after charging. If it is commission before charging, so at that point of time, how do we first calculate the commission? Profit before commission, that is whatever expenses or incomes you have recorded, we will take all of those into consideration. Normally, how we calculate profit, we will arrive at that value. This would be before commission because now itself you're calculating commission. Multiply it with rate of commission divided by 100. This is if it is before charging commission. Next, commission on net profit after charging such commission. After charging such commission. In this particular case, what happens here is the profit, whatever you arrive at, would also have an impact of the commission amount already. So you are still not aware of what is the commission amount. That is what you are finding in that particular calculation. So that point of time, just check the numerator. You will take 100 plus rate of commission, as if we have included that percentage also here. Clear? Yes. So these points, whatever you just saw now, was with respect to the items appearing in profit and loss account. Last part, balance sheet. The balance sheet, which is nothing but a statement, it just presents your assets and liabilities of the sole proprietor or of a firm as on a certain date. That's why you present this as balance sheet as on that particular date. What is the value of assets and liabilities you are reflecting? That's why it is presented on a certain date. Arrangement of assets and liabilities. There is an order how you have to arrange the respective assets and liabilities. We will first understand this for assets. See, assets may be grouped in one of the following two ways. First is based on liquidity. That is how quickly you can convert it into cash. Based on the liquidity, if you observe, see, the asset is arranged starting from cash in hand, cash in bank, then all those investments. At the end they have fixed assets, because this is presented on liquidity basis. That is how quickly it will be able to convert it into cash. Similarly, on liability side also, if you observe, they are first reflecting all current assets, because these becomes quick liquid enough, and then non-current, and then capital. The first structure was based on liquidity. Second structure is based on permanence. That is, first you reflect those which are long term in nature and not meant to be sold. Assets which are most liquid, such as cash in hand, are presented at the bottom. So first we start with fixed tangible and intangible assets, other non-current assets, and then current assets. Also on the liability side, we start with capital, then non-current borrowings or non-current liability, and then current liability. Clear with this? For liabilities, there is no separate category like liquidity or permanence. See, liabilities may also be shown according to the urgency with which payment has to be made. That is separate category for liability. One way is to first show the capital, then long-term liabilities, and last short all short-term liabilities. The other way is to start with short-term liabilities and then show long-term liabilities. So this is incidentally talking about what? The permanence approach, and this one based on liquidity approach. So this was the order of arrangement. Ma'am, if nothing is mentioned in the question, what is the way we have to present? You can by default go with permanence approach. That is, first on the asset side, start with all fixed assets, then other non-current assets, and then current assets. And then on the liability starts with capital, non-current liabilities, other non-current liabilities, and then current liabilities. This is the default format if nothing mentioned. Clear. Like we mentioned about current assets, long-term assets, the meaning of this is just given. What is current assets? Those assets which are converted into cash as quickly as possible. As quick means what is the time frame? Generally within 1 year. Long-term assets, those assets which are used by the firm over a long period and not sold in the ordinary course of business. Intangible assets, it is nothing but which have no physical existence and cannot be seen or touched. Liabilities, current liabilities, this is talking about settlements, must be settled in 1 year or less. It is also called as short-term liabilities. Long-term liabilities means which exists for more than 1 year are long-term liabilities. So as we saw the format for trading and profit and loss account, here I've also given the format for balance sheet. Just have a look at it. See, first tangible fixed assets, what all comes? These assets will have to be reduced with depreciation, or if there is any accumulated or provision depreciation, and then show the final amount in the outer column. Likewise with intangible assets, any investments, and then all current assets. Here on the liability side, for capital exclusively, observe, we will have the opening balance, and then to this add or less any current year net profit or net loss. Any drawings we will subtract, because as we understood with the journal entry, it is the owner's balance itself. If they have drawn, the balance will come down, so we will have to reduce this. Then long-term loans, short-term loans, current liabilities, and then if there is any provision other than bad and doubtful debts, other than connected to debtors, will come here as provision. So see, there is no hard and fast rule regarding presentation of assets, liabilities and equity. The model presentation shown above has been designed considering the nature of balance sheet elements and categorizing them appropriately. This is just like an accounting convention, guys, that is commonly followed by majority of the business. So that is why this becomes a normal suggested presentation. So that, but there is no any hard and fast rule that it should be done as given above. So whatever we discussed with respect to each individual items, I have just given one small table here, which definitely helps you to summarize the entire thing in a small time. First, you also give the reading for all those which we understood one by one, and then look at this. Just try to yourself figure out first before looking at the answer. So then it becomes easier with respect to the calculation while we take up the question, guys. So you can go through this. Now we will move to questions. Yes. Question number 1. Sen Gupta and Co. employs a team of 8 workers who were paid. Team of 8 workers who were paid 30,000 per month each in the year ending 31st March 2021. At the start of financial year 21-22, the company raised salaries by 10%. So that increase by 10% is now revised as 33,000 per month each. On 1st October 21, the company hired 2 trainees at a salary of 21,000 per month each. The workforce are paid salary on the first working day of every month, 1 month in arrears, so that the employees receive their salary for Jan on the first working day of Feb. That means first they will make sure the service is delivered, and then first of the subsequent month the salary will be paid. Now, what is the requirement of the question? Amount of salaries which would be charged to profit and loss for the year ended 31st March 2022. Now, I've put this question just for you to get that strong conceptual clarity on the items what we have to reflect in the current year. Remember, guys, here we have to reflect current year expense because the entire details is about salary expense. So that's why we have to find out what is the amount of expenses belongs to the current year. What is the current year which is ending on 31st March 2022? That is, they have given at the start of financial year 21-22. So if you observe, is this information relevant for us? Yes, only with respect to number of workers. 30,000 is not at all considered for the current particular year. Okay, so first, amount of salaries which would be charged to profit and loss account. Remember, when they are asking you the amount which needs to be charged to P&L, always consider that you have to record the amount for a period of 12 months. Clear? So in this case, for number of workers who are 8. So what is the per month salary? Workers salary is equal to 33,000 per month. How many months? I will have to record it for 12 months into 8 workers. First, I am recording this for workers. Then we will look at for trainees. How much will this be? 33,000 into 12 into 8. 31 lakh 68,000. Next, trainees salary. There were 2 trainees. Trainees were paid how much? 21,000. Now, observe one thing carefully. Company hired trainees when on 1st October. So, in the current year, the trainees have worked just from October to March. So, be careful here. So, how many months? October, November, December, Jan, Feb, March. So, for 6 months into, there were how many trainees? 2. 2 trainees. So, this will be how much? 21,000 into 6 into 2. This will be 2,52,000. So totally both of this will be the amount of salaries which need to be charged to profit and loss account. So amount of salaries for the year ended 31st March 22 will be rupees 31 lakh 68,000 plus 2 lakh 52,000, that is 34 lakh 20,000. Understood this? Next. Second point what they are asking is amount actually paid as salaries during 21-22. Again, the current year amount actually paid. Now the point comes here. See here, the question clearly says that whatever salary they pay is 1 month in arrear. Correct? So we actually calculated what should have been the salary. The requirement of the next question is what is the actual amount which is to be paid. Now, if you consider for workers, they would have paid only for 11 months, yes or no? Because for March, for the month of March, the salary would have been received only on 1st April. That falls for the next financial year. So, therefore, workers would have received just salary for 11 months. And for trainers, not for 6 months, only for 5 months. So, this will be the amount actually paid as salaries. Amount actually paid as salaries. That for worker 33,000 per month into 11 months, there were 8 workers. So this will be 33,000 into 11 into 8, 29 lakh 4,000. For trainees, 21,000 per month into 5 months into 2 trainees. So that will be 21,000 into 5 into 2, rupees 2 lakh 10,000. So actually paid for the year 21-22 will be rupees 29 lakh 4,000 plus rupees 2 lakh 10,000. That will be rupees 31 lakh 14,000. Clear? Yes. Next, outstanding salaries as on 31st March 2022. Now, in this case, we know what was the salary which was to be taken for a period of 12 months. Another side, we also know how much is actually paid. The difference between the two is nothing but outstanding. Yes. So, outstanding salary as on 31st March 22. Amount of salary for 21-22 minus actually paid for 21-22. So what was the amount of salary? 34 lakh 20,000 minus rupees 31 lakh 14,000. So this will be 3 lakh 6,000. Now if you want to give individual breakup, you can also do it likewise. 31 lakh 68 minus 29 lakh 4. And then for trainees, 2 lakh 52 minus 2 lakh 10. Clear with this? Yes. This question was just to make you comfortable with respect to the treatment of current year expense, that is expense outstanding and accrual. Yes, moving on to the next question. Mr. Mohan gives you the following trial balance and some other information. So they are giving you the trial balance, capital, sales, purchases, all of the items are given. So additionally, in other information, they've just given closing inventory and furniture. Remember, closing stock treatment, this is not appearing in trial balance. So it appears on two cases, two treatments. Additionally, in this question, if you see, there is GST balance is given. So, with respect to GST, remember the concept of utilization of input tax credit, guys. That concept becomes important here in your final accounts chapter when they integrate GST concepts. See, with respect to utilization, let me give you a quick summary. With respect to this utilization of input tax credit, you can also refer my video on accounting for GST where you will understand that with some examples. Okay. So, now what to know with respect to input tax credit? If there is any input tax credit balance, it is as good as you have some asset with you. Why? Because any balances which are there which I can utilize to pay off my liability, so that becomes my asset. So here what is representing my liability? It is all your output taxes, that is output CGST, output SGST and output IGST. All these represents your liability. Input CGST and input SGST represent your asset. Now, when they are giving you such details, you have to apply the concept of utilization of input tax credit. Now, first let's understand with output CGST. Output CGST, if there is any input CGST balance, first priority goes with that. And then if there is any IGST balance, that can be utilized for paying CGST liability. Clear with this? Yes. Now with respect to output CGST, see I have already have input CGST of 10,000. So can I make use of this to set off output CGST? Yes. I can only require how much? 8,000. So still 2,000 I have extra in my input CGST. Yes or no? Yes. Next, similar to my output SGST. My output SGST balance is just 8,000. Output SGST can be set off with only input SGST, and if there is any IGST balance, that can be utilized. So do I have any SGST balances? Yes. Again, that is available at 10,000. So this 10,000 can also be again utilized for paying this 8,000. Clear with this? Yes. Now if you observe, after setting off, input CGST still have 2,000 left and input SGST still have 2,000 left. Now, in this case, there is one IGST balance. If you remember IGST utilization, IGST credit can be utilized first for IGST itself, and then IGST can also be utilized for paying any CGST or SGST balances. In this case, that was about if there is any excess balance in IGST. Now, we have excess balance of output IGST, that is a liability. Incidentally, we have balances left in CGST and SGST as input. So, don't you think we can still make use of these balances for paying output IGST? Yes or no? Yes. So now this 6,000, whatever I have balances of 4,000 in total. That is from CGST and SGST. I will utilize that to pay my 6,000. So ultimately, if I net off all of them, I will just be left out with how much? 2,000 as my output IGST. So this output IGST represents your liability. So this will be reflected in your balance sheet. I hope all of you understood the treatment. Yes? Yes. So let's understand this question, how to solve. What is the requirement? Prepare trading and P&L for the year ended and then balance sheet of Mr. Mohan as on that date. So first of all, as I told, trading and profit and loss, you can also present it separately or you can just prepare one whole account. See, as I've just taken the format here, which will be just an extension after we complete trading account. So I will put the heading as trading and profit and loss account for the year ended 31st March 2022. Likewise, balance sheet will be written as on and not for the year ended, because this will be presented only on the particular date, 31st March 2022. See how to solve a final accounts question. It is always better to open all the accounts, that is trading, profit and loss, and balance sheet. As and when we run through the items with respect to the note in the adjustments, your first approach will be to reflect on adjustments. Then, as and when we run through, it becomes easier for you to enter simultaneously if you have opened the respective account. If not, this might consume a lot of your time. So it is always better to open first the formats. By presenting it, it becomes relatively easier. So first they have given capital balances. So capital comes where? In the balance sheet, liability side. So we will record capital. I will record this in the inner column because some treatments of drawings or net profit loss need to be taken. This capital, we will understand it to be our opening balance. If nothing mentioned, that becomes our base. Sales, 9,70,000. This comes in which account? Trading account. Buy, sales, 9,70,000. Why am I writing in inner column? Sometimes there might be returns. We have just not run through the entire question. See, there are returns. So it is always better to enter it in the inner column. Then purchases, 4,30,000. First will be opening stock. 4,30,000. Then opening inventory, 1,10,000. 1,10,000. Then to freight inward, remember inward is in the nature of direct expense. So it comes in trading account. To freight inward, 40,000. Next, salaries. It comes in profit and loss. So I will just leave some space and then continue my P&L. To salaries, 2,10,000. There is no adjustments like outstanding prepaid. So I'm directly entering the amount in the outer column, 2,10,000. Other administration expenses, 1,50,000. To other administration expenses, 1,50,000. Furniture, 3,50,000. This is coming in balance sheet. There was a depreciation also. So we will write it in the inner column. 3,50,000. Furniture. Then trade receivables and trade payables, 2,10,000 and 1,90,000. Trade receivables is my current asset. No other adjustments, so we will directly enter in the amount column. Trade payables, 1,90,000. Returns on the debit side, returns on the credit side. What does this mean? This is the trial balance, so this will be debit column, credit column. Returns on the debit side means what? It is a sales return. Returns on the credit side means purchase return. This can also be called as return inward and return outward. So 20,000 is your sales return minus returns, 20,000. Then 12,000. Then there is discount. Debit side discount will be discount allowed. Credit side will be discount received, 19 and 9. Next, bad debts. Bad debts appearing in the trial balance, that means treatment is already done. So you will just record it as a normal loss. Normal loss means it will come in profit and loss account. Two bad debts, 5,000. Next, investments in government securities. It becomes your non-current asset. So it appears in balance sheet. Investment in government securities, 1 lakh. Then there is cash in hand and bank, that is 1,89,000. Then there is GST. So for that we can just calculate it here. Whatever I've explained, we are just presenting it here. Output CGST, output SGST, and then output IGST. These balances are what is given to us. So output CGST was 8, 8 and 6. Utilization of input credit, full 8,000 for CGST and full 8,000 for SGST, that is respective input CGST, input SGST. If not, we can just write it separately also so that you guys need not get confused. Input CGST, then input SGST, 8,000 here. So here there is no balance left. From input CGST, I still had 2,000 left. So I will give that for output IGST. From input SGST, I still had 2,000 left. So that I will give it for IGST. So here I will be left with 4,000 more for IGST. Sorry. So here I'll be left with 2,000 more with respect to IGST. Now this is in respect of output IGST, which is your liability. If there was any excess balance in input, so that becomes my asset. So this will be reflected in the liability side as current asset. Output IGST 2,000. So we completed this treatment. Then other information, we have closing inventory. So we will record it in the trading account by closing inventory 1,80,000. One more, it comes in the balance sheet. Closing inventory 1,80,000. Then we have depreciation on furniture at 10% minus depreciation at 10%. So this will be 35,000. 3,15,000. So this is one treatment. One more will appear in your profit and loss account. To depreciation on furniture 35,000. So we have completely recorded all the items given. So now let's close the accounts. 4 lakh 30 minus 12,000 is 4 lakh 18,000. 9 lakh 70 minus 20,000, 9 lakh 50,000. 9 lakh 50 plus 1 lakh 80 is 11 lakh 30,000 minus 1 lakh 10 minus 4 lakh 18,000 minus 40,000 is 5 lakh 62,000. This is your what? Gross profit. By gross profit carried down by gross profit brought down 5 lakh 62,000 plus 9,000, 5 lakh 71,000 minus 2 lakh 10 minus 1 lakh 50 minus 19,000 minus 5,000 minus 35,000, 1 lakh 52. What is this? Your net profit. Net profit carried down. Where will this be taken? This will be transferred to your capital account. Since it is a profit, we will add net profit 1 lakh 52,000 plus 6 lakh 50 will be 8 lakh 2,000. Now just check whether your balance sheet is tallying. 3 lakh 15 plus 2 lakh 10 plus 1 lakh 1 lakh 89 plus 1 lakh 80, both sides 9 lakh 94,000. I hope all of you understood, guys. Just new topic here was with respect to GST. This we have understood in the accounting for GST itself. Here, just the classification becomes important. You can just make a note that if there is any output balances left, that becomes your liability. If there is any input balances left, that becomes your asset. This balance is arrived only after you give a proper set off. Is this clear? Yes. Moving on to next question. The next two questions becomes very important, guys, because this is how the full-fledged questions comes in the exams. This is also an exam question already asked for 15 marks. So let's understand this properly. From the following schedule of balances extracted from the books of Mr. Prakash, prepare trading and profit and loss for the year ended 31st March 2024 and the balance sheet as on that date after making the necessary adjustments. So they've given us the trial balance and they've given a set of items. So we will understand this one by one. And then first criteria, when you spend the time on reading the question, it is always important you spend it on adjustments, guys, because anyway the item given in trial balance you will have to record, you will have to run through, so you need not waste time reading those individually. Always spend time on reading the adjustments. Yes, the value of stock as on 31st March is 7 lakh 65. So what is this they are talking about? This is nothing but your closing stock. This includes goods returned by customers on 31st March to the value of 25 for which no entry has been passed in the books. Goods returned by customers means it is your sales returns. For this, there is no entry at all passed. Now, what should we do? First of all, if the goods are returned to you, sales returns, don't you think it should be included in your closing stock? Yes or no? So whatever they are telling, this includes goods returned by customers is not at all a problem. It should have been included, it is included. But when they tell that no entry has been passed in the books, that means sales value, whatever is reflecting, does not show the net of returns. So that needs to be considered. Also, since this is appearing in your adjustments, your debtors balance will also be affected because when sales returns is done, what is the entry we pass? Sales returns account debit to debtors. So your debtor balance will also come down. So that needs to be taken care. Next. Purchases include one furniture item purchased on 1st Jan for 10,000. Your total purchase expense should reflect only revenue expenses. But what have they done? They've also included furniture purchased here. So that needs to be removed. And after you remove for this is the depreciable asset. So depreciation should also be treated. Yes. Then depreciation at 10% is to be provided on furniture. That is whole furniture value. Then 1 month's rent is outstanding and 12,000 is payable towards salary. So rent is an expense. So 1 month is outstanding. Whatever value is given. So 66,000. What do you understand by this? This is just representing 11 months rent. 1 month rent is outstanding means you have to be able to find this out all by yourself. Yes. And then 12,000 is payable towards salary. What does this mean? It is outstanding. It is yet to be paid. Next, interest paid includes 9,000 paid against bank loan and interest received pertains to investments and deposits. So they're just giving a justification for whatever values which is given. Interest paid, interest received. Why? We will understand this. Provide for interest payable on bank loan and interest receivable on investments and deposits. Provide for. See, if you observe here, they are giving us the percentage. Using this percentage and date, don't you think we can calculate the amount of interest? Yes. Likewise, for investments and deposits also, they are giving us percentage and dates. For this also, we can calculate the amount of interest. So using this, what should we do? We have to compare with what amount they have been already recorded. There could be differences where completely they would have not recorded. So that needs to be considered. Yes. Next, make provision for doubtful debts at 5% on the balance under sundry debtors. Here you should be careful on the balance because remember from the first point that there will be impact in your debtors balance. Then insurance premium includes 18,000 paid towards proprietor's life insurance policy. What does this mean? This is in the nature of personal expense, which is nothing but your drawings. So this insurance premium which is debited here 30,000, 18,000 includes personal expense. So we have to remove that and then show it as drawings. These are the adjustments which needs to be given importance, and then one by one we can treat the items accordingly. What was the requirement of question? Prepare trading P&L and then balance sheet. Let's begin the question. Trading and profit and loss account for the year ended 31st March 24, and then balance sheet as on 31st March 24. Now, if you are wondering how much space will you assume, ma'am, while we are solving, you just put it on some estimation basis, guys. There is no problem if you are losing on some extra space. Make sure you provide more. So here, if I sit and draw the format, again, it would be time consuming. Hence, I've just made it in advance to save time. Yes. So let's start recording the items here. First, capital account. This will come in the balance sheet, 8,85,000. Eight lakh 85,000. Then stock on 1st April 23. This is nothing but your opening stock balance, 3,86,000. Trading account to opening stock, 3,86,000. Then cash in hand, 18,500. Cash in bank, 73,500. 18,500 and 73,500. What is this? Cash in hand and cash at bank. Next, we are done with this, and this. Since I am scrolling up and down, I'm just ticking so that we will not miss any item. Investment at 9% as on 1st April 2023. See, investments, whenever you come across, is nothing but my non-current asset. So this will appear as my assets. Investments, what was the value? Investments is 50,000. With respect to this, there is some interest calculation which needs to be done. We will address that when we come to that particular point. Deposits. Deposits, again, if you observe the balances given on the debit side, it is nothing but your advances given in the nature of receivable. So again, this becomes your asset. So deposits is how much? 3 lakh. Next, drawings 78,000. Drawings is also already present. So here minus drawings. Remember there was some additional items. So we will just write one particular thing here, 78,000. Then purchases 24 lakh 95,000 to purchases. Like I explained earlier, if there could be any returns, we might not be aware of that. So it is always better to write it in the inner column. Then we have sales 29 lakh 86,000. Return inwards. What does return inwards mean? Sales return. So minus sales return 1 lakh 10,000. 1 lakh 10,000. Return outwards 1 lakh 38,000. Then carriage inwards, it is again a direct expense, so comes in trading account 1 lakh 26,000. 1 lakh 26,000. Next, rent 66,000. Rent, if they just give normal rent, we will treat it as an indirect expense. So to rent 66,000, there was one particular adjustments. We can address it now itself. 1 month's rent is outstanding. So rent, whatever is given as 66 is representing your 11 months rent. So we can calculate 1 month's rent. 66,000 divided by 11. So 6,000 is my 1 month's rent. So how do I present this? 66,000 outstanding rent for 1 month is due. Is this belonging to current year? Is it a current year expense? Yes. So what should I do? I will have to add to the existing balance. So I will call this as an outstanding rent. 6,000. So current year total rent which needs to be debited to P&L should be 72,000. So this was taken from adjustments. Adjustments will have two appearances. One we have shown it in profit and loss. One more will appear in balance sheet liability side because it is an expense outstanding. Outstanding rent 6,000. Next item, salaries. Salary is 1 lakh 15,000. Same. For salary also there is 12,000 payable, that is outstanding to salary. 1 lakh 15,000. Add outstanding 12,000. So 1 lakh 15 plus 12 will be 1 lakh 27,000. Two appearances, one more in balance sheet. Outstanding salary 12,000. Next. So this point is done. Sundry debtors balance is given 2,35,000. So this is my current asset. Two lakh 35,000. Sundry creditors 1,37,500. One 37,500. Then we have bank loan at 12% as on 1st October 2023. First of all, bank loan is a long-term borrowing. So liability side 2 lakh. Furniture 25,000. Assets, we will write it in the inner column 25,000. Advertisement, normal indirect expenses 40,300. 40,300 and 2. The next item there was printing and stationery. To printing and stationery, that is 32,200. Then we have electricity charges 57,700. Electricity charges, if they are mentioning on factory, then it will become a direct expense. Since nothing mentioned, we will normally assume it as indirect expense. To electricity charges 57,700. Then there is discount allowed, that is 55,200. Discount received, that is 24,600. Then there is bad debts. Bad debts, remember, it is coming in the trial balance, so you will only take it as normal loss. To bad debts 18,500. I'll write it in the inner column because we have provision treatment, or else there is just one provision. You can also enter it in the outer column and then write it separately. Let me show this in the outer column itself. 18,500. Then to general expenses 36,800. To general expenses 36,800. Then there is motor car expenses. They have directly given it as expense, so we will treat it as normal expense and not as an asset. To motor car expenses, we have still not recorded interest paid or received because we have adjustments there. Then insurance premium 30,000. It is your normal indirect expense, but there was an adjustment for it. Insurance premium, I'm writing it in inner column because there was an adjustment 30,000. Then to traveling expense, to postage courier, to traveling expenses, and then to postage and courier. To traveling expenses is 21,800 and 8,100. Yes, we have done all of these. Interest paid and received are yet to be recorded. Now moving on to adjustments. The value of stock as on 31st March 2024 is 7,65. So by closing stock 7,65,000. This includes goods returned by customers on 31st March to the value of 25,000, for which no entry has been passed into the book. So, if it is included in the closing stock, it should have been included. That is correctly done. Yes. No entry has been passed in the book means there is no sales return treatment given. So, first we will have to record this as sales return minus returns 25,000. This is one treatment. One more, because when sales return happen, debtors balance comes down. So we will also reduce debtors minus returns 25,000. So this is done. Next, purchases include one furniture item purchased on 1st Jan 2024 for 10,000. So first we will have to remove from purchases minus furniture value included, that is 10,000. Now this 10,000 which is included was part of furniture. We will have to add it there. So add included in purchases 10,000. Connecting to this point, they have also told depreciation at 10% is to be provided. Now, we have to be very careful here, guys. See, in furniture, there are two balances. 25,000 is from the beginning. That is 1st April 23 until 31st March 24. Whereas, if you observe this 10,000, this is only for 3 months. That is Jan, Feb, March. Where is it given, ma'am? See, observe in the same line. Purchases include one furniture purchased on 1st Jan. So, while you calculate the depreciation, you should be careful in order to take the proportion here. So, first on 25,000 for whole year minus depreciation at 10%. So, 25,000 into 10% plus 10,000 into 10%. How many months? Jan, Feb and March. So 3 by 12. So what will be the total depreciation? 25,000 into 10%, that is 2,500, and then 10,000 into 10% into 3 divided by 12, 2,750. So total depreciation is 2,750. This 25,000 plus 10,000 minus 2,750 will be 32,250. This depreciation needs to be recorded in profit and loss account. To depreciation on furniture 2,750. Yes. So second point is done. 1 month's rent is outstanding. We have also considered that. Next point is very important. Understand this carefully, guys. Interest paid includes 9,000 paid against bank loan, and interest received pertains to investments and deposits. First, let's focus on interest paid. What is the total interest paid? It is showing 12,500. Out of this, they are telling 9,000 is paid towards what? Bank loan. Clear? Now come to the bank loan value. What is the bank loan amount? 2 lakh. Bank loan is borrowed on which date? 1st October. Your year is ending on 31st March 24. So let's calculate the actual interest on bank loan. 2 lakh into 12% into October to March, October, November, December, Jan, Feb, March into 6 divided by 12. So this has to be 12,000. Have you shown the full interest? That is 12,000? No. We have only been recorded how much? 9,000. Understand this carefully, guys. Do not get confused. Interest paid will not only represent total bank loan interest. That is why specifying in the total interest paid 12,500. 9,000 is representing what? 9,000 is representing bank loan. So, don't you think 3,000 is yet to be recognized, which is not at all shown? Yes. So, first, it becomes an interest which is outstanding, correct? Because interest on bank loan is your expense, correct? So, therefore, you will have to reflect this additionally with respect to the loan. Where and all will this come? First, to interest paid. 12,500. This is normally there. For this, I will add 3,000 more. Outstanding interest on bank loan. This is 3,000. So total interest paid should have been 15,500. Is this point clear? Now this 3,000 will have two appearances. First, we have recorded a bank loan. For this, outstanding interest should also be shown. Outstanding interest on bank loan. 3,000. Is this understood to all of you? Yes. Next, interest received pertains to investments and deposits. Likewise, let's observe how much is interest received. Total interest received is 28,500. Now we have to calculate what should have been the interest income from investments and deposits. First, for investments, 50,000 at 9%. So this should have been 4,500, correct? So this is taken on 1st April itself. So full year. Then next, 3 lakh again on deposits. This is also from 1st April full year, 30,000. Now total, if I have to see 30,000 plus 4,500, total interest which I was supposed to receive was 34,500. But how much I have actually received? Only 28,500. So there is a shortfall which belongs to the current year income. So that will be recorded. Since this is an income, this will be receivable. So it will also be shown as an asset. So by interest received 28,500. 28,500 plus interest receivable on investments and deposits. How much? That is 34,500 minus 28,500. How we got 34,500? 4,500 plus 30,000. So 6,000. This will be 34,500. Accrued interest 6,000. Clear? Yes. So this point is covered. This point is covered. Make provision for doubtful debts at 5% on the balance under sundry debtors. So bad debts is already done. For that, they are asking us to create new provision. This needs to be recorded separately. 5% on the balance debtors. So balance debtors means 2,35,000 minus 25,000. Whatever is left on that, we have to take how much percentage? 5%. So minus provision at 5%. So that will be on what value? That will be 2,35,000 minus 25,000. 2,10,000 into 5%. This is 10,500. So how much will this be? 2,35,000 minus 25. minus 10,500. This is 1,99,500. So this provision, since we have created, it should be recorded in profit and loss account. 2. Provision for, this was what debt? Doubtful debts. That is 10,500. How did we get 2,10,000 into 5%? Is this clear? Yes. Next, this is done. Insurance premium includes 18,000 paid towards proprietor's life insurance policy. So we have also already recorded insurance premium. We have to remove this minus proprietor's share. That is 18,000. So 30 minus 18, 12,000. Since this is in the nature of drawings, it will be added to total drawings. 18,000. 96,000. So now we have entered all the values. So first let's close. First record those items which are need to be entered in from inner column to outer column. 1,38,000 minus 10,000. 23,47,000. 29,86 minus 1,10,000 minus 25. This is 28,51,000. All here entered. Yes. 28,51,000 plus 7,65 is 36,16. 36,16,000 minus 3,86,000 minus 23,47,000 minus 1,26,000. 7,57 is my gross profit. To gross profit carried down by gross profit brought down 7,57,000 plus 24,600 plus 34,500. 8,161. 8,01,000 6,100 minus 1,27,000 minus 72,000 minus 40,300 minus 32,200 minus 57,700. Just a minute. 757 plus 24,600 plus 34,500 minus 1,27,000 minus 72,000 minus 40,300 minus 32,200 minus 57,700 minus 55,200 minus 18,500 minus 36,800 minus 8,500 minus 12,000 minus 21,800 minus 8,100 minus 2,750 minus 15,500 minus 10,500. 2,97,250. So this is what, this is my net profit. To net profit carried down, this will be added to my capital net profit. 2,97,250. 885 minus 96,000. So 10,86,250. Just check the total of balance sheet. Plus 2 lakh plus 6,000 plus 12 plus 137,500 plus 3,000 minus 32, 250 minus 50, 3 lakh, 199, 500, 18, 500, 100, 6,000. Any other items missed to enter here? Closing stock need to be entered here. Closing stock 7,65,000. Now let's check the total. 32,250 plus 50,000 plus 3 lakh plus 7 lakh 65, 199,500 plus 18,500 plus 73,500 and 6,000. So this will be 14 lakh 44,750 on both sides. Just cross checking. Yes. So this is the total of the balance sheet. This question, as you saw, was lengthier with respect to a lot of items, but if you have that strong conceptual clarity, it becomes easier. It might take some time, but if you attempt this, definitely you can score full marks. Don't you think so? Yes or no? Yeah. So moving on to the next question. The following are the balances as at 31st March 2022 extracted from the books of Maple States. So they are giving us the various items. Then additional information. Purchases include sales return of 2575 and sales include purchases return. So there is a crossover of returns. We have to take it properly. So before we run through the additional information, let's look at the requirement. Prepare a trading and P&L account for the year ended 31st March and the balance sheet. Additionally, they're also asking us to show the rectification entries. This is a very important question, guys. Please understand every point carefully. This is also asking us rectification entries. Why rectification entries? Because first, additional information itself had an error. Okay. Next, goods withdrawn by Mr. XYZ for own consumption 3,500 included in purchases. Again, there is an error. So it has to be eliminated from purchases and should be recorded as drawings. Yes. Next, wages paid in the month of April for installation of plant and machinery amounting to 450 were included in wages account. This was incurred for installing plant and machinery. So it should be debited to plant and machinery, but they have taken it to wages account, which is again a mistake with respect to accounting principle. Then free samples distributed for publicity costing 825. This is just given as an additional information. If they tell you here, that means there could be no entries passed yet. So we will have to record the entry. Error of omission. Create a provision for doubtful debts at 5% and provision for discount on debtors at 2.5%. So whatever you find it in adjustments will be for new provision. So let's cross check. Was there any old provision? Yes, there are old provision available. Next, depreciation is to be provided on plant and machinery at 15% and on furniture and fittings 10%. Bank overdraft is secured against hypothecation of stock. Bank overdraft outstanding are considered as 80% of real value of stock, deducting 20% as margin, and after adjusting the marginal value, 80% of the same has been allowed to draw as an overdraft. So we have understood, read through all the additional information points. So we are aware what points are important, and then there are some items here as well. So first, let's address the respective items given and then rectification entries and then the additional information treatment like we followed in the previous question. Plant and machinery 19,550. So it appears in my balance sheet. First, debit, credit, trading and profit and loss account for the year ended. When are they asking? 31st March 2022. And then balance sheet as on 31st March 2022. So first item what we saw was plant and machinery 19,550. 19,550. And then furniture and fittings. How much is furniture and fittings? That is 10,250. Then we have bank overdraft 80,000, which is your current liability. Next we have capital account 65,000, drawings 8,000. Minus drawings. Since there was one more, so we will write it what informations is readily available now. 8. And then purchases 1,60,000. There was opening stock, so 2 opening stock 32,250. So wages 12,165. I'm writing it in the inner column because there was one error. Next, provision for doubtful debts 3,200. So we will come back to this while we take up the adjustments. Debtors 1,375. Sorry, this is provision for discount on debtors. Sundry debtors 1,20,000. Creditors 47,500. Then there was bad debt. Bad debt coming inside the trial balance. That means it is already treated. So it will be a normal loss 1,100 to bad debts. Since there is provision, so I will help you out how the treatment should be done here. That's why I'm writing this in inner column. Then bad debts recovered. This is like a normal income. So put it on the credit side of P&L. By bad debts recovered 450. 450. And then salaries 22,550. See, in this case, there is also salaries payable given in the trial balance itself. Till now, what you saw, some adjustments which were giving us the additional information that for so and so months only it was paid. So then we were recording the outstanding treatment separately, and then the two appearances was coming one more in the balance sheet. Since if the information is already given in trial balance, that means the treatment is already provided. So you need not again give it in the profit and loss. What does that mean? Salaries, whatever is reflecting as 22,550 is already been treated with salaries payable. Is this clear? So this will appear in P&L and this will appear in the balance sheet. 22,550 to salaries 22,550, and then there is salaries payable 2,450. Next, prepaid rent and rent. Same consideration again. When it is appearing in trial balance, the entry is already reflected. So this is in the nature of receivable, comes in the balance sheet. Rent directly in P&L. 300 and 4,300 to rent, prepaid rent 300. Next, carriage inward. It is a direct expense. Carriage outward is an indirect expense. 1125 1350. 1125 1350. This is carriage inward, and then to carriage outward. Next, sales 2,15,300 by sales 2,15,300. Then there was advertisement expense, printing and stationery 3350 1250. 3350 1250. To advertisement, there was an adjustment for this, so it is better we write it in the inner column. 3350. To printing and stationery, next cash in hand 1450, cash at bank 3125. 1450 3125. Cash in hand and then cash at bank. Office expenses 10,160. To office expenses 10,160. Then interest paid on loan 3,000. To interest on loan 3,000. Now we have entered all of the items which were part of trial balance. Now moving to additional information. See, as and when we run through the additional information, if there requires a rectification journal entry, we will also simultaneously pass and give the treatments accordingly. Purchases include sales return of 2,575 and sales include purchases return of 1,725. So first we will have to eliminate these returns. Purchases include sales return. This should not have been included in purchases. We need to remove. So what will be the first rectification entry for this? Purchases should be removed, means purchase will have debit balance, so we will credit. What needs to be created? Sales return account. So what will be the first entry for first transaction? Sales returns account debit to purchases 2,575. Similarly, and sales include purchases return. Sales should not have included purchase return, so we have to eliminate it. Sales will be credited, so if we have to remove the balance, we will debit. And purchase returns need to be created, so we will credit. Sales account debit to purchase returns account. How much? Being 1725. being sales return wrongly included in purchases, being purchase returns wrongly included in sales. So for this, we will also simultaneously treat. So in purchases, I will have to take the sales return minus sales return 2575, right? 2575. And this should have been included in sales return. So minus returns 2575. For purchases 1725, this needs to be removed. Purchase returns 1725. This should have been actually subtracted from purchases returns. So minus returns 1725. Is this clear, guys? Yes. Next point. Goods withdrawn by Mr. XYZ for own consumption 3500 included in purchases. So this 3500 should not have been part of purchases. This is a drawings. This has been wrongly treated as purchases. So first rectification entries. Purchase balance should come down and drawing should be debited. So the journal entry for this will be drawings account debit to purchases. How much is this? 3500. Being personal expense wrongly treated as purchases. Clear? Now for this, we will also have to make the treatment. We have now reduced the balance of purchases. So minus drawings wrongly included 3500. Now this 3500 should be additionally added to drawings plus 3500. Clear? Yes. Next point. Wages paid in the month of April for installation of plant and machinery amounting to 450 were included in wages account. This should not have been included in wages. This should have been directly debited to plant and machinery. So we have to rectify this entry first. So what will be the rectification entry? Plant and machinery need to be debited. Plant and machinery account debit. 2. Wages should not have been debited. Since they have debited, we have to eliminate the effect. 450 being wrong debit to wages instead of plant and machinery is rectified. 450, right? Yes. So since the entry is being passed, we will also reflect this in the treatment. Wages minus wrong debit. So this will be 12,165 minus 450, 11,715. This needs to be added to plant and machinery. Add included in wages 450. Yes, next point. Free samples distributed for publicity costing 825. So for this, what will be the journal entry? Advertisement account debit to purchases. So that entry is not at all recorded. Advertisement account debit two purchases. What was the value? 825. Being goods distributed as free samples, entry omitted to be recorded. Okay, 825. So for this, we will also show this in the financial statements. Advertisement is an expense. There was already an amount, so we will add to it. Add goods distributed 825. So we will have to 825 subtract it from the purchases minus goods distributed as free samples 825. Next, create a provision for doubtful debts at 5% and provision for discount on debtors at 2.5%. See, this is nowhere a rectification, so we will have to directly treat this. Provision for doubtful debts at 5%. So we already had some existing provision. Remember, I told you the format. You will add new provision, you will subtract the old provision. We already had bad debts. So old provision for doubtful debts is 3,200. Let's go to profit and loss. Yes. Minus old provision. How much was that? 3,200. Plus new provision. Now this new provision, we need to calculate. Our debtors balance was 1,20,000 on that 5%. Minus provision for doubtful or bad debts. This is doubtful debts. This is 1,20,000 into 5%. That is 6,000. 1,14,000. Now this was provision for doubtful debts. New provision is 6,000. So this will be 1,100 minus 3,200 plus 6,000, 3,900. This was point with respect to bad debt. Now there is one more provision for discount on debtors. Remember, this is given only for good debtors. So our good debtors are 1,14,000 on this 2.5% minus provision for discount. So 1,14,000 into 2.5%. This is 2,850. So your final debtors balance will be 1,11,150. This 2,850, there was also existing provision 1,375. To provision for discount on debtors. What was the new provision? 2,850 minus old provision. Same logic what we understood for doubtful debts. Old provision was something 1,375. 1,375. So this will be 1475. Yes. So this point is done. Next, depreciation is to be provided on plant and machinery at 15% and on furniture 10%. On plant and machinery 15%. See, in this case, unlike previous question, there is no dates given. So on total, that is 19,550 plus 450, you will charge 15%. 20,000 into 15%. So this will be 3,000. 19,550 plus 450. 17,000 on furniture, 10%. 10,250 into 10%, that is 1025. 9,225. So this have to be recorded in the profit and loss account. So depreciation, plant and machinery, it was 3,000. On furniture, 1025. 1025. So this will be 4025. Is this clear, guys? Yes. Next point is very important. Carefully understand this. Bank overdraft is secured against hypothecation of stock. What does this mean? That is as good as giving it as collateral or as pledge. You would have learned this in your law, hypothecation. Bank overdraft, that is whatever that facility of loan is given, that is being safeguarded by taking stock as a collateral or pledge. Bank overdraft outstanding as on 31st March 2022 has been considered as 80% of real value of stock, deducting 20% as margin, and after adjusting the marginal value, 80% of the same has been allowed to draw as an overdraft. First of all, you have to observe one important thing. Every question would have closing stock. So in this question, did you observe closing stock given anywhere? Neither it was present in trial balance nor it is present in additional information. So this point, whatever adjustment which we are going to address now is mainly on our closing stock. See, why? Because they are specifically mentioning on stock. First, let's understand what is this. First, this business has been allowed a bank overdraft. For bank overdraft, the safety is their stock. Now, this stock is nothing but taken as on the closing stock value. What amount is being given? First of all, if you observe, bank overdraft value was given in the question. How much was that given to us? See, this is 80,000 provided. So what does it sell? This 80,000 has been considered first of all as the security purpose. Whatever was the value of stock, we are just considering 80%. That is what the bank is telling. On top of that 80%, value of 80% is just given. That is what this means. Are you all understanding? So here, if I take, for example, let's take it as a working note, closing stock. So if I take closing stock as X, bank overdraft is already given as 80,000. How is that arrived? Closing stocks 80% is what they consider as the real value, correct? This is what this part says. Bank overdraft outstanding as on 31st March has been considered as 80% of real value of stock, and after adjusting the marginal value, that is 80%, 80% of the same has been allowed as an overdraft. So this, after adjusting this 80%, on top of it, again 80% is what we are giving as bank overdraft. That's what the statement means. So this is 80,000. How is this 80,000 is already given to us in the question. So can we find out what is X in this? Yes or no? Yes. So 80,000, if I just cancel out zeros here, So I'll be left with 80,000 into 100. So this side it will be 64x is equal to 80 lakh. X is equal to 80 lakh divided by 64, that is 1 lakh and 25,000. So if you recalculate 1 lakh 25,000 into 80% is the real value of stock. On top of it 80% is what they are giving as bank overdraft. So by closing stock 1 lakh 25,000. This closing stock will again come in the balance sheet. 1 lakh 25,000. Clear, guys? So now we have completed all the arrangements. Let's find out the values. 1 lakh 60 minus 2575 minus 1725 minus 3500 minus 825 is 1 lakh 51,375. 215,300 minus 2575 minus 1725. This is 2 lakh 11,000. 1 lakh 25. 3 lakh 36 is what I am getting. Minus 32 250 minus 151 375 minus 11 715 minus 1125. This is 139 535. What is this? This is my gross profit. To gross profit carried down by gross profit bought down 1,39,535 plus 450. That will be 139,985. Let's observe. Minus 22,550 minus 4,300 minus 1,350. Just a minute, we have not taken advertisement total here. It is 4,175. So 139,985 minus 22,550 minus 4,300 1,350 4,175 minus 1,250 minus 3,900 minus 10,160 minus 3,000 minus 1,475 minus 4,025 139,985. Just a minute, I'm cross checking. This is 83,800. So this will be my net profit carried down. Net profit we will add to the capital balance of 65,000 minus 11,500 plus 83,800. This will be 137,300. Check the total of balance sheet plus 80,000, 47,500, 2,450 minus 17,925, 111,150, 300, 1,450, 3,125. Yes, so the total of balance sheet will be plus 2,450, 2,67,250. This will be your total of balance sheet. This question, as I mentioned earlier, is important one, guys. First, understand how to solve and then try to practice from your end once without looking at the solution, so that is the process how you gain the confidence while you solve the question. I hope this session was useful for the time you have spent so far, guys. Let's bring that excellent output to whatever study time you're investing. You are doing wonderful. Just a round of applause for that. Keep giving your best. Every day is definitely nearing towards your success, guys. Work on it. Believe in yourself. You will definitely achieve it. Until I see you in the next video, take care, guys. All the very best. Stay healthy.